Hey everyone, billionaire investor and portfolio manager Bill Ackman has 37% of his over $10 billion portfolio in just two stocks. And I agree with him on one of the stocks. I'm bullish on the same stock that he's really bullish on. And the other one, I can understand why the investor is attracted to that stock. So let's take a look at these two stocks and the reasons why I think Bill Ackman owns these and what has him thinking that they're going to generate strong returns on investment.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. So, like I mentioned, this investor, Bill Ackman, owns 37% of his portfolio in these two stocks. Technically, they're three stocks, but it's one of them is the same company, right? Alphabet has A shares and C shares. One of them has voting rights, the other one doesn't. And so two of the stocks are those split 12.7% in GOOG and 5.85% on GOOGL. I tend to recommend whichever one is trading at a lower valuation. For most investors, the voting rights do not matter. You don't have enough voting rights to influence anything at the company. For some investors, if you're owning a large percentage of the company, the voting rights make a difference because it gives you a chance to influence the board of directors. You can vote in a director of your choosing, and it increases your chance of getting that director elected. But for most of us, that voting power doesn't really make a difference. So we'd prefer, or I'd prefer, the shares with the lower price. So the other stock I'm going to talk about is Chipotle Mexican Grill, which he owns 18.15% of his portfolio in Chipotle Mexican Grill. So let's take a look at these one at a time, starting with Chipotle and what has Bill Ackman attracted to Chipotle stock. So one of the reasons why Chipotle is an attractive investment is because of the solid revenue growth. I have here a 10-year chart of revenue for Chipotle compared to Domino's and McDonald's. And you can see Chipotle in the purple there, demonstrating growth over the last decade. It's adding new locations robustly at a larger percentage than Domino's or McDonald's is, even though the others have more locations. The rate of growth in new locations is faster for Chipotle, and the company thinks it can grow to roughly double the size it is today in terms of the number of locations, while the others, they might be growing but not at that rate. 9.872 billion in revenue compared to 4.479 billion for Domino's, and the lower revenue total for Domino's is not indicative of the size of the company because it has more locations than Chipotle does. And then McDonald's decreasing all the way up to 2020 and then finally now doing better. Actually, McDonald's did a really good job during the pandemic in adapting and expanding its digital service. It's now got a robust app that customers are finding very useful, and more of their orders are coming online. But that's a story for another video. Chipotle, meanwhile, is not only growing its revenue, but it's also doing so with a relatively strong profit margin. You could see Chipotle's profit margin expanding here ever since the disaster of the food outbreak. I think it was an E. coli outbreak or some outbreak in their food where customers who were eating their food were getting sick. Me and my wife were a victim of that. We ate Chipotle's food and we were sick, and many customers got sick, and so that caused the company significant headwinds, and they've now since recovered from that since 2015 2016, and you can see their profit margin expanding since then. Domino's 18.3% compared to Chipotle at 16.5%, and McDonald's at 46.07%, the most profitable of these three. Interestingly, Chipotle is the only one of these three that's not running on the franchise model. It's not running on the franchise model. Domino's and McDonald's are on the franchise model, which makes it easier to generate profits because you're taking royalties from your franchisees, and those come with lower expense compared to running your own locations where you're having to serve customers, pay for food, pay for wages, and all of that weighs down your profit margin, as has Chipotle's profit margin. But when you look at the return on invested capital, you'll notice that Chipotle has done a really good job expanding this metric, 45.29%, 60% for Domino's, and 26% for McDonald's. So Chipotle is right up there with the giants, doing a great job generating great returns on invested capital. Generally speaking, anytime you have an ROIC over 12% for a established company, that's good. And when you surpass 20%, now you're getting really, really good. Anything above 30%, now you're getting into the excellent category. And Chipotle has put itself in the excellent category for returns on invested capital. The one gripe I have with Chipotle is the valuation. Chipotle is trading at a forward price to earnings of 46 compared to 28 for Domino's and 19.86 for McDonald's. So while Chipotle is growing faster than these other two restaurant stocks, it's also trading at a significantly more expensive valuation. That's my only concern with Chipotle. Otherwise, it is arguably the best in class restaurant operator. It's done a great job, especially after that outbreak in 2015, 2016 when customers got sick. It's done a great job returning and retrieving trust from their customers and expanding revenue and profitability. Excellent return on invested capital. Management saying that they can grow their locations to nearly twice where they're at. And management has already delivered great results in terms of the amount of revenue per location. That's done a great increase over the years. And Chipotle is one of those few management teams that I've said has done a good job in going into the pandemic and coming out of the pandemic. McDonald's didn't do that great going into the pandemic. Domino's did great going into the pandemic, but didn't do so great coming out. Chipotle was one of the few that did great going in and coming out. Management adjusted, was the quickest to adjust to the digital offering, the take home offering, the delivery offering, and it was on point, and that helped the business really, really well during the pandemic. And of course, coming out of the pandemic, it's absolutely thrived as people have preferred going out and eating away from home more often. The next one, Alphabet, in his portfolio. I mentioned that one of the two stocks I strongly agree with his purchase, and it's Alphabet. Alphabet I've recommended as my top stock to buy in 2024. I made that recommendation around December 30th, December 31st, and I've reiterated that recommendation several times. I think Alphabet is a phenomenal business, excellent business model, 307 billion in revenue in trailing 12 month. You can see that growing from roughly 70 billion in 2015. And I've compared it with Meta Platforms here, who's the next closest in terms of ad revenue generation. And Alphabet has trounced Meta Platforms. In terms of operating profit margin, Alphabet's done a good job, 27.42%, growing slightly over the last decade, while Meta Platforms has had a hard time keeping its margins where they were. Its margins have decreased over the last decade to 34.66%. And then looking at return on invested capital, Alphabet and Meta Platforms are relatively similar at 26%. And Alphabet's return on invested capital has been increasing from around 15% up to 26% most recently. The job cuts and cost cutting efforts Alphabet implemented in 2023 and late 2022 are going to help boost its return on invested capital. In recent years, prior to this cost cutting effort, I felt that Alphabet was getting a little bit sloppy in terms of their expense control. Employees were getting treated to some lavish perks, massage therapist on site, and food, and all of these other lavish perks. And wages were getting elevated, and the number of employees was getting elevated, and the number of projects they were going after that were outside of its core capabilities was growing wider and wider. And so I was glad to see them get some cost control under their belt, lay off some people, keep costs down, and I think that's going to help their return on invested capital improve over the next several years. And finally, they're not trading at expensive valuations. Especially Alphabet is trading at a relatively cheap forward price to earnings of 20. Forward price to earnings of 20.57, I think, is a bargain for Alphabet stock. And it seems like Bill Ackman also agrees and thinks it's a bargain. In fact, Alphabet stock is trading at a similar valuation to McDonald's, right? Think about a high-tech company like Alphabet with a dominant market share in search and a dominant social media business in YouTube, or you could say a streaming business in YouTube, is trading at a valuation that is very close to McDonald's. McDonald's is at 19.86 and Alphabet is trading at a forward PE of 20.57. So for all these reasons, I agree with Bill Ackman in this one, and I've recommended Alphabet as my top stock to buy. But it's interesting here that Bill Ackman has 37% of his portfolio invested in just two stocks, even though one of them I think is a really, really good stock. The other one is a really good business. I don't know if it's a really good stock or not because of the expensive valuation. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.